What if the problem isn't inflation? But who gets the money first? We're told that printing money helps everyone. It saves jobs, stabilizes markets, and prevents collapse. When prices rise, we're told it's temporary. When savings shrink, we're told it's unavoidable. Yet something doesn't add up. Every time money is printed, asset owners seem to get richer. Governments expand power. Financial institutions grow larger. Meanwhile, ordinary people work longer hours, save more carefully, and still fall behind. So here's the mystery that challenges everything we've been taught. If printing money is meant to help the economy, why does wealth quietly flow upward every time it happens? We're not just talking about inflation. We're uncovering why money creation enriches power, while ordinary wealth slowly disappears. Setting the stage, the promise of easy money. To understand this, we need to start with a promise. For centuries, money was hard to create. Gold had to be mined. Silver had to be refined. Governments couldn't simply create wealth. They had to earn it through trade, taxation, or conquest. This imposed discipline, but it also limited flexibility. Wars were expensive. Crises were brutal. Recessions were hard to stop. So modern finance introduced a seductive idea: elastic money. If money could be created as needed, economies could be stabilized, panics could be prevented, growth could be managed. Central banks emerged as guardians of this system, independent, technical, and supposedly neutral. Printing money wasn't framed as enrichment, it was framed as protection. But embedded in this promise was a twist that few understood at the time. Whoever controls money creation doesn't just stabilize the economy, they shape it. Origins: when money stopped representing value. The story begins when money stopped being a thing and became a process. Originally, currency represented stored value. A gold coin was valuable because the metal itself was scarce. Paper money was simply a claim on that metal. But during the 20th century, especially during wars and depressions, governments suspended these limits. Gold backing was reduced, then removed entirely. Money no longer represented something scarce. It represented a promise. And here's the critical cause and shift. When money creation is detached from real value, it becomes a political and institutional tool. Printing money didn't immediately make people richer or poorer. It changed where money entered the system, and that changed everything. The rise: who gets the money first? This is where the real mechanism reveals itself. When new money is created, it doesn't fall evenly into everyone's pockets. It enters through specific channels: governments funding deficits, banks receiving liquidity, financial markets absorbing stimulus. Those closest to these channels receive the money first. This is known quietly as the first mover advantage of money creation. By the time newly created money reaches workers and consumers, prices have already adjusted. Assets rise first, stocks inflate. Real estate surges, wages, they lag. So while the system claims neutrality, the effect is systematic enrichment of those closest to power. This isn't a conspiracy in the shadows. It's a predictable outcome of how money flows, the breaking point, when printing becomes necessary. Over time, economies become dependent on this mechanism. Debt grows. Markets expect support. Governments rely on borrowing, and central banks are trapped by their own success. If they stop printing, markets crash. They continue printing, purchasing power erodes. So they choose the option that preserves the system. And this is the breaking point for ordinary wealth. Because once money printing becomes necessary to maintain stability, inflation is no longer an accident. It becomes a feature. Savings lose value slowly. Cash becomes a liability. Long-term planning becomes harder. Meanwhile, those with assets, leverage, and access to credit ride the wave upward. Power compounds. Ordinary wealth decays. Fallout: the invisible tax. Inflation is often described as rising prices. But that's only the symptom. The cause is dilution. When money is printed, every existing unit of currency represents a smaller share of the economy. This is a tax, but unlike income tax, it's never voted on. It hits savers first, fixed income earners next. The wealthy last, if at all. And because it's gradual, it rarely sparks revolt. People adjust. They blame companies. They blame supply chains. They blame each other. But the underlying mechanism remains untouched. Money printing shifts wealth upward quietly, without headlines, without debates, without consent. Failed fixes why nothing seems to work over the years. Policymakers have tried to manage the consequences. Price controls, interest rate hikes, stimulus checks, regulatory tweaks. Each fix treats the symptom, not the structure. Raising rates slows inflation, but risks collapse. Stimulus helps temporarily, but fuels future inflation, controls distort markets, and fail. Why do these fixes keep failing? Because the system itself requires money creation to survive. Debt must be serviced. Markets must be supported. Confidence must be maintained. Real reform would require accepting short-term pain, and modern political systems are designed to avoid that at all costs. So the cycle continues. Modern parallels history speeding up today. This pattern is accelerating. Money creation on a scale once considered impossible has become routine. Balance sheets expand. Emergency tools become permanent. At the same time, asset prices outpace wages, homeownership drifts further out of reach, savings lose purchasing power year after year. And digital money promises efficiency, while centralizing control even further. The language evolves. The logic doesn't. Print to stabilize. Print to protect. Print to prevent collapse. And each time, power consolidates while ordinary wealth thins. The deeper pattern why power always wins, here's the uncomfortable truth. Money printing doesn't enrich everyone. It enriches position. Those positioned closest to financial infrastructure benefit. Those further away absorb the cost. This is repeated across centuries, empires, and systems. Rome diluted its coinage. Early modern states inflated paper currency. Modern economies expand balance sheets. The technology changes. The pattern remains. Money creation is never neutral, because power determines distribution. 3 clear takeaways. First, printing money is not just an economic action, it's a distribution decision. Who benefits depends on where money enters the system. Second, inflation isn't random or temporary. It's the predictable result of sustaining debt-driven systems with continuous money creation. Third, ordinary wealth disappears not through sudden collapse, but through slow erosion that feels normal until it's irreversible. Final warning, the open question, the real danger isn't that money is printed. It's that people stop questioning why and for whom. Because once wealth erosion becomes normalized, expectations adjust downward. What was once stability becomes luxury. What was once freedom becomes survival. The question we're left with is simple and unsettling. If power controls money creation, and money shapes reality, who is the system really designed to serve? Call to action. If this video helped you see money, inflation, and power differently, subscribe for more deep dives into the hidden mechanics of finance. Share this with someone who still believes inflation is just bad luck. And remember, when money is created without limits, power compounds, and ordinary wealth fades quietly into history.